So my concern is we just don't manage this transition well, and we get into a situation where we have a lot of energy spikes, and that just doesn't look good for the industry.
Welcome to Energy Vista, a podcast on energy issues, professional and personal trajectories. I'm your host, Leslie Palti-Guzman. In each episode of this podcast, we chat with energy experts from all around the world. We exchange on timely energy issues as well on their life experience. You will learn a lot, whether you're an energy aficionado or a newbie. It's October 28, 2021, and time for a new Energy Vista episode. Today, I'm exchanging with Peter Coleman, an established executive with 35 years in the oil and gas industry, former CEO of Woodside, and presently sitting at the board of Schlumberger, while also advising an Australian renewable energy company focused on green hydrogen. Peter joined Energy Vista from Australia. Good morning to you, Peter.
Good morning, Leslie, and thanks for having me.
Thanks. So I'll start by asking you, how do you feel in today's market? You left Woodside earlier in 2021 after 11 years at the helm of this large integrated upstream supplier with maybe more than 4,000 employees. And now we see this unprecedented turmoil in energy markets with skyrocketing prices across multiple commodities. And I'm curious what's going through your mind.
Well, what's really going through my mind is the value of preparation. And if you think about the industry, since 2010, we've been through a couple of cycles now. First one, of course, was in early 2015. We had another dip in 2016, and we thought we were pulling ourselves out of it. And then, of course, COVID came along in early 2020. But all of the fundamentals were there for a correction in the market. And so what you do as a company, as an organization, is you prepare yourself. You always prepare yourself for the downturns in the market so you don't have to do things that you wish you didn't have to do. And often that's around job cuts, people in the organization. You want to make sure you can continue to progress your projects, but you're going to have to put some things, just hit the pause button for a while. And of course, we did that at Woodside. We hit the pause button, but more importantly, we went back and said, how can we make some of our projects better? What you're seeing now in the marketplace, to be honest, was very predictable. And it was something that we were talking about when COVID hit. We saw prices, spot prices for JKM as low as $2. And we start to see behavior in the marketplace that we know is just simply not sustainable. Now, it takes a firm belief in the commodity cycle and the fundamentals of supply and demand, and there's lots of moving parts. But really, where we are today was very predictable around 18 months ago. Now, of course, we couldn't have predicted JKM prices above $30, but we certainly did see a strengthening of the prices. We saw a strengthening of crude. So, how do I feel today? Well, sometimes you've got to, these are like riding waves into the beach. And at the moment, the industry's on the top of a wave.
Right. And so what do you think are the most important factors, or the most important factor that you think has contributed to the imbalance between demand and supply?
Oh, really, what happens is people get lapsed into a false sense of security. So, we can talk about cold winters and so forth, but the reality is we have cold winters every few years. And that's actually quite predictable. We can see what's happening in the marketplace. I think what happens more and more, though, is you're seeing more cargoes go into the short-term market or even the spot market. So short-term being contracts of 1 to 3 years, or the spot market itself. And in some instances, you're finding that buyers' procurement processes, particularly if those buyers are utilities, are not flexible enough to be able to, push those cargoes through the system at a time that's early enough. They can't be speculators, and particularly major government entities are really not allowed to speculate. It's not in their mandate at all. And so they're typically price followers in the marketplace. They're rarely a price leader. And so you find they just simply don't buy when they should be buying, often because their procurement rules don't allow them to. They don't allow them to get ahead of the game. And that when you've got a lot of buyers doing that, of course, it just starts to add up. So I think, people were sitting on the fence just wondering when COVID would go away. I think the economy's been stronger than a lot of people thought it would be. And, of course, it's come back really hard and people just haven't been prepared.
And when you look at this energy crunch with gas, but also other commodities, what are you the most worried about?
Well, what I'm worried about, to be honest, is underinvestment in the sector in the short to medium term, whilst we redirect capital into renewables. Now, of course, you're seeing it in kind of different levels as we kind of look at large international oil and gas companies, independents, private companies, and then national oil companies. They're all kind of behaving in different ways. Large international oil companies are putting more and more of their capital budget now into renewables. So not only did they come out of COVID with their balance sheets stretched because some of them continued to pay dividends whilst prices were low, so they actually ran debt up on their balance sheet. They're now trying to pay that back, so their total capital spend has come down. But very importantly, the percentage of renewables in that capital spend has gone up, which means, the oil and gas spend has actually had two hits, not only from an overall capital reduction because of balance sheet repair, but also because of a different allocation of that capital, more going into renewables. Now, private companies are not doing that. They're still spending. Some of the large independents are still spending, but national oil companies are increasingly starting to put some of their capital into renewables as well. So my concern is we just don't manage this transition well, and we get into a situation where we have a lot of energy spikes, and that just doesn't look good for the industry. I mean, people already are saying this is an industry that they don't want in the long term. And if they start getting hit in their gas bills or when they go to fill up their motor vehicles and so forth with high prices because of underinvestment, that really worries me.
Yeah, I join you here. I mean, I'm very worried about, especially when I look at Europe and those soaring prices that could fuel European populism and extremes. And, for example, France is heading into a year of election in spring 2022. And historically, higher energy prices and electricity prices have fueled discontent. So that, for me, that's worrying also. And the other thing is potentially the rising CO2 emissions, because we see that many countries are putting in place mitigation strategies because of those high gas prices and are going to do some more fuel switching, potentially with even dirtier fuels than gas, with coal, with diesel, fuel oils. And we're ahead of heading into the weekend of COP26, and some countries will come at the table with potentially more greenhouse gas emission balance than anticipated earlier.
Look, I think you're right, Leslie, and that's just the economic reality of societies as they work their way through this energy transition. So I think it's a real wake-up call for policymakers to see how finely tuned the system is, and that you can't simply turn one thing off and then hope something else fixes it. Gas in Europe is an interesting one for me, and I think we need to think about Russia a little differently than what we have before. Russia has more customers now. It has a very big customer to the south that it's now strategically supplying gas to, being China. It's typically sent all of its gas east or west, I should say, to Europe. But now increasingly more and more of its gas is going into China. So I think what we're seeing both within the gas system and then also in the oil system, some of what we call nominal spare capacity may not actually exist to the extent that people think it is. And what we're going to have to do is keep the systems at plateau production for longer periods during the year, meaning that the shoulders are going to be longer as we fill storage. We just simply, I think we're getting to a point where we simply can't turn the taps off and top it up as quickly as we used to be able to. And that's exacerbated when you start to shut in fields like Groningen and so forth in Europe, and of course the decline of the North Sea gas fields, particularly in the UK sector. So there's a number of factors there, I think, that are playing out this year. On the crude side, of course, we've now got very low OECD inventory levels or global inventory levels. And we're still relying on the Saudis to be able to top up at any point in time. But I'm a little concerned about the messages we're getting out of the Middle East with respect to the capacity, because they have taken a lot of very, very large projects to FID recently, and that would suggest to me that the capacity or the tail of capacity that they've got maybe only 2 or 3 years, and having to invest quite heavily to keep that capacity level up.
Very interesting. You mentioned earlier like this kind of dual investments in renewable on one hand and the need still to invest in fossil fuels. Do you think there is going to be a reckoning among policymakers and broadly in the population about the role of natural gas in the energy transition?
Well, I think it's a reckoning with policymakers, but also with shareholders, to be quite frank. If you look at some of the large national oil companies and international oil companies, they are huge dividend payers, and so they go into pension systems. If you think about the amount of dividends that both Shell and BP contribute to the UK pension system, it's absolutely enormous. Similarly, if you go to the US and you look at Exxon and Chevron and so forth, there are enormous amounts of dividends that are going into the system. So I think there's a long-term issue around, can renewables actually return the same sort of dividends, and what do these companies look like? At the moment, renewables can't. Renewables is just simply capital growth, and you are receiving single-digit capital returns on your investment. And of course, large companies can't leverage themselves up like special purpose vehicles can. So I think there's going to be a reckoning, not just with policymakers and consumers, but in particular shareholders and expectations of shareholders and the pressure they put on boards and management with respect to their returns.
So there was this story in the Wall Street Journal today during your night, so I don't know if you saw it yet. But the activist investor Third Point is pressing Shell to split, actually. And to your point, it wants to separate the legacy business from the more renewable business. Which is interesting to me is that they put LNG and renewable together. But increasingly more CEO from big IOCs are vocal about saying that renewable is not what is going to bring us cash flow, and we still need those legacy businesses actually to run the business and invest in renewable.
Yeah, look, I hear that, but look, I think there's a reality, and every large company has to face that reality. Is what are you? And it could simply be that the model of oil and gas, or traditional oil and gas in the way that we've thought about it, and renewables is just not a model that's going to naturally work. It's a very difficult model to pull off, simply because you have competing needs. Now, there'll be an argument on one hand that says, all right, the oil and gas can be the cash engine for renewables. That's all fine, but you still need to continue to invest in oil and gas. We know on average oil and gas globally declines anywhere between 4 to 5% per annum. That's a huge amount of capital that needs to continue to be reinvested into oil and gas. Equally, on the renewable side, as I said, the issue there is just simply being able to get long-term contracts that are able to underpin these investments. And so it becomes a bit of a chicken and egg. And then getting renewable projects that are large enough to make a difference. You don't see $20 billion or $100 billion renewable projects around the world. A $2 billion renewable project is a big project. And so the ability to deploy capital at scale is also limited in renewables at this point.
Yeah, over the past few years, we've seen that the LNG industry was slowly becoming more commoditized. There was more liquidity. But do you think that is going to be halted with what we're seeing in the market? Some suppliers are back at praising, the more vintage, rigid commercial structures, like including long-term contracts, oil indexation, and also like the current volatility may push buyers to sign more new long-term contracts. So do you think we'll see actually less liquidity in is it the right assessment to question spot markets and hub indexation?
Well, I think people were hoping, spot might be able to go the way that other commodities have, like iron ore and so forth, which is pretty much sold on a liquid spot market globally. I think what you're seeing here is that buyers of natural gas in particular have other social requirements. If you don't provide iron ore, then it's fine. The only thing that shuts down is the factory. If you don't provide gas to Tokyo or to Beijing, that's a really big social problem, and people literally freeze.
Mm-hmm.
And so there are requirements of some of those buyers that go, above simply a commercial transaction. And for those buyers, they need the surety of long-term contracts. So I think what you're going to see here is, the number's probably not going to get more than 30%. I think people thought it was going to get much higher. But, again, we were predicting a few years ago when people were asking about this, it was very clear. We said there will be more volatility in the market. So for those players who can't stand volatility, then this is going to be very difficult. Now, European players are used to volatility. So if you look at European customers, they are very sophisticated in their ability to manage volatility in pricing. That's not the same as you go into Asia. So the systems are not as mature with many of the Asian customers, and their processes are not as mature. And so their ability to handle volatility, particularly pricing volatility, is much less. And you're seeing that play out now, particularly in China and Korea.
So right now, Glasgow is happening with COP26. How should we think about Australia? What should we expect? I feel that for producing and exporting nations, it could be like a critical time because governments can decide either to take some historical decisions or more opportunistic ones. And when we look at Australia right now, the country is going to get massive revenues from the exports with those prices. So, I think the ministry was saying a record of 349 billion to the country. And on the other hand, they are the international community pointing their fingers to Australia for failing to increase their emission reduction targets. How should we think about Australia's position?
Yeah, look, to be honest, I think the policymakers allowed this to go on for too long. The policymakers were always going to have a net zero target by 2050. It's just taken them too long to get their minds to it. And of course, now they've become, the targets of criticism as people come to COP26 and are quite rightly saying you would never have gotten there unless we had embarrassed you. So it's kind of one of these arguments that says, look, you always knew you were going to get there, so why didn't you just get there sooner? The reality, though, is some of the politics in Australia, and we've got to put it into context. Australia has lost 4 prime ministers over this issue. So it's not a trivial issue for the political class in Australia at all. It's a very significant issue. And it's simply around, it's not the people in the city, it's the people in the regions that are affected by this. And you can go through Europe and you can look at decisions also that have been taken on a regional basis to continue to ensure that jobs were there. And so the affected communities are not in the cities in Australia. The affected communities are in the regional and country areas. And they're the ones that are very concerned about this. And government really, up until now, has not been able to put a plan on the table that says how will those communities transition. The other part you mentioned is very, very important. The taxes and royalties that the Australian government receives from exports is extraordinary and is a major part of our economy. We're not a consumer-based economy like the US, for example, that generates more than 60 to 70% of its GDP comes out of its own consumption. Australia is an export economy, and people just need to realise that. So it's easy to throw stones when you're sitting in a large economy that's driven by your own activity. But that's not Australia. Australia is a large continent, and its economy is driven by exporting things. And unfortunately, at the moment, exporting requires the use of fossil fuels in its extraction as well. So they're on a path. They know that they need to catch up and hurry up. The reaction to the Prime Minister's announcement of net zero by 2050 has been quite muted here in Australia. So I think most people said we'd already moved on as a society. Why have you, the political class, taken so long to catch up? But that's politics sometimes. So I think things will catch up very quickly.
So you mentioned the big driver of Australian economy, which is the export market, and one of the big markets is China. And recently, we've seen retaliations from China for political moves that Australia has taken, especially with some commodities. And at the same time, the US is pivoting to Asia, creating an alliance with Australia in the Pacific region. How should we connect both? Like, do you think that the US and Australia are geopolitical allies in the region, but potentially trade competitors when it comes to energy resources? Right now, they are both the largest exporter actually of LNG to China. So do you think that increasingly they are going to fight for the same market share, but at the same time be aware of protecting shipping lanes, energy security in general in the Asia Pacific region?
Look, I would characterize the alliance with the US as one of mutual dependencies, but it's really a defence and intelligence alliance that we have. Again, Australia as a nation, needs large friends, and the US has been there for Australia since the Second World War. So, there's a relationship that goes back a long time, and of course, some of the issues that we've had, Australia's had with China recently, have not been with respect to commercial deals and so forth. It's really been issues around national security and so forth, and the influence of some individuals and companies around national security. So I think you have to separate them, because if you look at it simply on the ground in Australia, for the most part, it's business as usual with China. It's a little more difficult, of course,
except for coal, no?
Yeah, look, you've got to be careful around some of these things. The reality is they are stockpiling coal, so it's not that coal is not going to China. It's just simply that it's not being used, and so you've got it sitting in ships and so forth. But they're small things, to be quite honest with you. The Chinese really haven't touched the two big markets, which is LNG and iron ore. And I don't expect that they will, because there is a mutual codependency between the two nations that will kind of ride out these kind of short-term political issues that need to be undertaken. So, bottom line is the relationship is still very, very strong. And I think, we just need to get about our business and let the political class sort these other issues out between themselves. Now, you asked for you asked for the US. One thing I avoided there was the US will go very hard commercially. So no, we don't think in any way, shape, or form that the US is ever going to give us any leeway in any trade negotiations and so forth. So the US quite rightly will push their product into whichever market they wish to get it into, and in Australia, we're just simply going to have to compete with that. We don't have some of the leverage they do in some of those markets. So, having worked for both a US company and an Australian company, I know the difference in the level of support that you get at a government level when you go in for these negotiations. It's vastly different. But that's just the way it is in Australia. It's been successful.
Well, it used to be, I think, correct under the Trump administration. We saw the government very much advocating for its exports and doing commercial advocacy for the U.S. oil and gas companies. I think it's less so under the Biden administration.
So I think you'll find the Biden administration is still in there supporting, just in a different way.
It's good to hear your perspective from Australia, because here in the US and in DC, I think people have been, waiting for the Biden administration to be more vocal about its support for the oil and gas industry. But we'll see. This crisis may force them out of their comfort zone and more clear positions about, the US exports, which actually have. Let's take the example of US LNG. I think that the situation could have been much worse if the US had not increased their exports about the past year, which, continue to grow because of new projects coming online. So let's move to your personal trajectory. So Peter, tell us a little bit about your path. What was your trajectory to become a CEO? For 11 years, you were actually a CEO. So tell us how did that happen?
Uh, well, it's the old saying. There's a lot of luck, a little bit of luck, and a lot of hard work in it. I don't know many people that actually start their career aspiring to be a CEO. I think at least I think the best ones kind of grow into it over time, and that was certainly the case for me. There was probably a point in my career where I said, yes, I like leadership and I would like to lead a company. But I was always comfortable with the roles that I had. So what you need to be really careful of is you don't covet positions and feel like that you want to get to a CEO role because you may make some poor choices along the way and you may not actually be ready. So I think, coming up through an organisation like ExxonMobil provided an exceptional grounding for me and opportunities global. So when I was
Mm-hmm.
the CEO of Woodside, a lot of the things that I needed in my toolkit I already had. Now, of course, I hadn't dealt with shareholders, and so that was different for me. So you had to learn some other things, but things around media and running large, complex organisations globally and so forth, they were things that were already there. It's a trajectory. I think you have to go through a lifetime of learning. You have to take each opportunity that's presented to you and do your very best with it. I think, too many people try and map out a career and try and work out
Mm-hmm.
each step. For me, it was simply saying, well, here are the things that I think are complementary to the last thing I did or to what I'm currently doing, and start to kind of build you. What are you? How do you sell yourself to the world or to the organization? What do you specifically bring? What are your skill sets and competencies? And I think as people think about their careers, they need to do things that are complementary and build on things. Don't just simply wander, but look for opportunities that are complementary and then grab everything that comes forward as though it's the last job you'll ever have and work it really, really hard. And I think if you do that and you build
Mm-hmm.
your support and your networks and so forth, then you can go through it. Look, running large
Mm-hmm.
organisations, the basic skill sets are not fundamentally different or leadership are not fundamentally different to what you do as first line supervision. The only difference is the complexity. So, but the actual skill sets that you need to lead your first team are very similar to the skill sets that you need to be a CEO running a large, complex organisation. The fundamental differences, though, are now that your horizon as to where you look forward changes. So when you're a first-line supervisor, your horizon might be next week, next month. When you're a CEO, your horizon
Mm-hmm.
becomes 5 years ahead, 10 years ahead.
Mm-hmm.
What does that look like? And it can
Yeah.
be a pretty lonely place for you as you think about it.
Yeah. And how were you making decisions? What was the most helpful for you when making decisions?
You had to think about things a lot. And so, one of the things that I was encouraged to do when I became a CEO was actually provide a space and time for me and me alone. And that's what I did as we built our office. Now, some people say, well, we want to see the CEO. An organisation, I can assure you, will take 300% of the CEO's time just because they want to talk to the CEO or they want to see the CEO walking the floor or they want to do this and do that. And I think you have to work out what's the right balance for your organisation. I used to always say to my team, if they're asking for me to talk to them, it means you're not communicating particularly well because you know what I know. So we're not going to tell them anything different, and you're their leader, so why are they asking to hear from me? But you do need to get in front of the organisation to reinforce things from time to time. But you really do need to set aside a place where you can just think, because the world becomes very complex very quickly, and if there is a tendency for you to go for sugar fixes and to be in the business each and every day. The problem with that is you are not doing the things that only a CEO can do. And there's about 40% of your job, anywhere between 40 to 60% of your job as a CEO, probably 60, that only you can do. So if you're down doing somebody else's job, then you're not doing your job.
Mm.
And I think, people get that confused sometimes.
Yeah.
And I think that's where also you see some CEOs don't last the distance for very long because they're a one-trick pony. They come in, they do one particular thing, and then it's time for them to get off the bus and somebody else to get on.
Yeah. What was the most difficult decision you took?
Sometimes the hardest decision is not to do something. So the easiest decision is to do things. Many of the difficult decisions we had were to walk away from things. Probably the more public decision that I made was walking away from the Leviathan project or Leviathan in Israel. And so, I was literally there ready to sign. I'd flown into Israel. It was my birthday. We were at the King David Hotel. We had the signing ceremony all organised and national television ready. And the rules changed.
Yeah.
So whilst I was on the plane flying there, the regulators decided to change the regulatory regime, and our partners decided to sign a contract that we had not seen. And so I just simply had to walk away from the project.
Wow.
Which was disappointing. We'd spent a lot of time on it, and it's an absolutely fabulous resource. But sometimes you just got to walk away from a deal.
Very interesting. Yeah, I remember that, but I couldn't remember the reason. And now we see that Chevron is in, and they just announced recently also like potentially an expansion of more pipeline from Israel to Egypt. And current prices obviously are motivating more production. It's interesting because the region is pretty much isolated right now from this. I mean, not the whole region, but there is a lot of production and oversupply around Israel right now, with a surplus ready to be exported. So it's interesting.
Well, it's an interesting one in for Israelis and having to deal with that, because for many years they thought they'd been bypassed with a fossil fuel endowment, and they thought all their neighbours had it, and they didn't. And of course, the Tamar field was discovered, and then of course Leviathan, and then across the border in Egypt, Eni discovered Zohr, and then there were some smaller discoveries off Cyprus. So there was a lot of debate internally when we were there around, do we keep this for Israelis for domestic use only, or do we utilise the export revenues and be able to invest it in other things? So, I think all of that has settled down now, and people are very clear around the fact that these resources are going to be there for a long time. And the reality is, if we don't use them now, then we may never use them. And I think that's probably the case in the region. So it's good to see a company like Chevron going in there and really vindicating what we were chasing at the time. So it's just one of these things. It just wasn't our turn. It was somebody else's.
Good. Well, thank you so much, Peter, for sharing your insight and your experience. I learned a lot, and I hope we'll hear more from you. Your knowledge needs to be shared and spread. Be vocal. This episode was recorded on October 28, 2021. This is Leslie Palti-Guzman saying good day and good luck.